Any opinions expressed in this program are those of the participants personally and do not necessarily reflect those of Rogers, Rogers TV, or of Graybrook Securities, Inc. Please consult a professional investment advisor before making investment decisions. Hi, it's Rav. You're watching Real Investments. Today we're talking about how to make money in a rent-to-own situation as an investor, making upwards of 25, 35, sometimes 40% annualized. My good friend Andrew MacDonald's here. This is his world. He's the expert in rent-to-owns. Andrew, it's great to have you on the show. You know, just before the break, we were talking about in detail how we can make money as an investor in doing this. It's a little different than a buy and hold. It's the same. We start from the same place, but it can be even more lucrative. You know, why don't you just take a few minutes and kind of really just break it down again and how we can be making the 25, 30% with the different components, you know, with the cash flow, with the mortgage pay down, with the fixed increase, all that kind of stuff.
Sure. So I think before we kind of went through it, you were just peppering me with questions a little bit, but maybe I can simplify it, put it in order, and help people understand maybe a little bit better. So what I always like to do with rental properties is liken it to a buy and hold property, and then I take that as kind of the plain vanilla strategy. That's, you know, the simple bread and butter of this world. What we do then is compare it to a rent-to-own property, and then I can kind of compare and contrast the differences. Okay. So if we continue with this $250,000 example, you'd probably need about $50,000 down on a buy and hold basis, plus your closing costs, right? So you'd need a little bit extra. As a rent-to-own, I find that the closing costs, as well as our fee, is usually offset by the money that the client is bringing to the table. So as an investor, that's nice. You can get into an equally priced property for a little bit lower down payment. And of course, that boosts your investment return. The two profit centers for rent-to-own are really on a monthly basis, which is where most of the profit comes, and then when you sell at the end. So every month on a $250,000 property, if we were renting it for $2,000 a month, there's almost a 50% profit margin there, because the investor's property taxes, mortgage, and insurance really aren't a whole lot. And on a normal rental property where we're renting it at, let's say, $1,400 or $1,500 a month, you know, there's a good profit spread there. But we also have that premium because of the fact that it's a rent-to-own. Most of the premium is going back to the client to help them with their savings. So every month, there's a good, healthy profit from the cash flow.
So with that 20% down on the $250,000, my mortgage is only $200,000. With today's rates, including taxes, it's only costing me $1,000 a month to pay taxes, principal, and interest. And in a normal situation, I would probably charge $1,400, $1,300. In this situation, I can charge $2,000. So you're saying it cost me $1,000, I'm charging $2,000. So I'm making double what it would cost. Of that $2,000, I'm kicking back to the tenant, putting it in a savings account for them, about $400 or $500 of that, $400?
Yeah, most likely. So the way that we determine that is really we want to make sure that the client wins at the end of the day. So we're starting off with 5% down, and we're aiming to get them up to at least 10% down. So whatever the difference is that we need to make up over that 3-year term, we give them enough credits to do that, and that's going to help them qualify for a mortgage down the road.
But for me allowing them to do that, I get a little premium on my cash flow that I wouldn't get if I were to do just a standard typical buy and hold.
Yeah, exactly. So they're giving you that extra savings plan every month. Instead of putting it into their own bank account, it's going into your bank account. And that's where you're able to transfer that return from the end, when you sell the property, to a monthly basis, right? And that's really the key benefit as a rent-to-own investor, is that you get that extra monthly cash flow, and you've got the 5% down up front, so you know you've got a good client there. And really, when investors start getting into real estate, they're often concerned with, what if the client damages the property? And what if the client doesn't pay rent and moves out? Then what am I going to do? If someone's giving you 5% down before they even move into the property, you know that they want to buy that house. You know they're going to take good care of it because they intend to own it at the end. And chances are they're not going to walk away.
Yeah, years and years ago when I did this, I structured it a little bit differently. I like your way better. And really, all the money's made on the cash flow, plus we get a little bonus, you know, when we sell it, because we're going to decide that it's 3% per year. In this case, that's $7,500 per year. But what I would always say, and what you just mentioned, is legally, the letter of the law says it's my home. Mine, Rav, is the investor. My house, rather. But the spirit of the law says it's your home because you're already invested. You've given me 5%. You're paying me premium rent. And so obviously you're going to take care of it. I love that. There's really no maintenance for me because this is really, in spirit, in essence, your house.
Exactly. So all throughout that term, the client still has the same pride of ownership. They enjoy all the benefits of home ownership, aside from actually being on title.
Yeah.
And then once they've fulfilled their obligations and they can get their financing, they'll qualify for the mortgage, take it off your hands, and now it's actually their property.
And so where do you find these tenants? Where do you find, I mean, these great people that need a little bit of help fixing credit and are ready to go? How does Andrew find those?
So there's really two avenues. One is going direct to the consumer.
Okay.
So we've got online advertisements on different classified websites. That's one way that gets a lot of traffic to us. And then the second way is to go out and work with real estate professionals. So if you're a realtor, you may come across clients who don't qualify for a mortgage.
Yeah.
Or more likely, if you're a mortgage agent, you see a ton of files come across your desk. Out of all of those files, some people will qualify and some people won't. So rather than taking the ones who don't qualify and just saying, sorry, there's nothing we can do for you, there's other lending alternatives like Ownership Solutions, and we can help them oftentimes when the bank is saying no. So our real bread and butter is the people that are getting declined by CMHC or Genworth
Yeah.
because they don't qualify, they don't fit the underwriting criteria,
Yeah.
and they're going to need at least 2 years before they would qualify for a mortgage. So we can take them, approve them, get them into a house, and they kind of shortcut the process of qualifying for a mortgage, but we'll help them with that and make sure that by the end of the program, they can go back and get the mortgage they need.
No, it's great. So you work with mortgage specialists. I mean, realtors to help you find, but you work with mortgage specialists. I would think you need even more than realtors in the sense that, yeah, there's people that they can't help, but if they had a Rav that could buy the property for them, they're really only dealing with Rav and Rav's credit, and so they make money because they're the one, they're making interest on the mortgage, and you're happy because you now have an investor and a tenant to put together. The tenant's happy because they have something that they can have the option to purchase, and obviously the investor's happy. I'm very happy if I'm making 25, 35% per year on my money. So what happens in this scenario? So it's $250,000. In 3 years, it's almost $275,000, and they haven't. They just can't purchase the property right now for whatever reason. They've changed their mind. They still don't qualify. The banks have changed the rules, and it's even harder to get a mortgage. What would happen in that scenario? I guess one of the things that could happen is we just write a new contract and keep going with it. So talk to me about that. And then secondly, if I needed my money as an investor, I guess I could ask them to leave and sell the property. I mean, what are some scenarios?
Sure. So before we get into all of that, what I wanted to do is cover off the second part of the profit. So the first part is the monthly cash flow.
Yeah.
The second, assuming everything goes as planned,
Yeah.
is that at the end of, let's say it's a 3-year term, which
Yeah.
we find is the most common term,
Yeah.
the client is able to get their mortgage, purchase the property, exercise their option,
Yeah.
buy it back at the $275,000. In that case, the investor's mortgage is going to have been paid down from what it was originally.
Yeah.
So there's a bit of profit there.
Yeah.
The 275 is higher than the 250,
Yeah.
so there's some profit there.
Yeah.
Minus whatever credits we have to give back to the client.
Yeah.
So most of the money comes on the monthly basis,
Yeah.
but there's also some profit at the end. And
Yeah.
again, we've got examples of how this should work on the website. Now, the more interesting part here, I guess, is addressing the what ifs, right?
Yeah.
So what if the client can't qualify?
What I call the risk, right? So
Yeah.
we're kind of going through those 4 questions that are important. What's the minimum? Well, it's 20% down, even though I'm getting back 5. The return is when they buy it. That's when I go plus the monthly cash flow, which is a lot better than most. And then the return, obviously, 25, 35% per year. So then what is the risk is really kind of what I'm asking. What's the worst case scenario? Which I think what you're going to tell me is there's not really a worst case scenario because I still win. I have a property that's been taken care of. But tell it to me anyways. Tell the viewers at home, what is the worst case scenario?
Sure. So what I'll do is kind of take you through varying degrees of worst
Please.
case scenario.
Yeah.
So I mean, what's probably most common as a things not going according to plan is that the client needs a little more time to fix their credit.
Yeah.
And we know that's going to be an issue in some cases. We can only guide them to the water. We can't force them to drink. We can give them all the credit suggestions in the world, but they
Yeah.
have to take those actions.
Okay.
So if they do need a little bit more time,
Yeah.
what we suggest is they exercise their option to extend the contract. And that's one of the clauses that we have because we know people sometimes need that. So in that case, the price will continue to appreciate.
Yeah.
But they get more time. And
Okay,
that's
so,
really
so
what they
it's
need.
built in the contract that they have the option. So Rav, if I wanted to sell it, I mean, obviously we could structure it any way, but typically, if I wanted to sell, I really can't, because I had agreed 3 years earlier that they have the option to extend. And being a prudent investor, I'm sure I probably would want them to do that.
Yeah, I mean, if someone's been paying you above market rent, they've been paying every month, you're enjoying this great cash flow, you can see the light at the end of the tunnel, that they're going to qualify soon. Why would you want to cut them off and say, no, sorry, I'm going to sell the property? I mean, where else are you going to get that kind of cash-on-cash return? If they've been good payers, not giving you headaches, you're going to want to keep them on board.
Great stuff.
Right? The second risk really is price risk, and this is something that we always explain to the clients. So the whole program relies on the fact that prices will continue to appreciate. Because if they don't get an appraised value of $275, they're not going to qualify for that mortgage. So in that case, there's a few things that can be done. One, the client might have to put in some additional cash to qualify for whatever mortgage they need. And then the other options really come down to what the client and the investor can agree on as a solution. So as an investor, if you want your money out, you might agree to, give them a haircut on the price of the property and say, you know what, I'm still making a good return. I get my money back. I can go invest in something else. You can buy the house. That's a win-win. The other thing you could do, maybe give them a vendor take-back mortgage for the difference that they need to qualify.
I can loan them the money.
Yeah, exactly. And then the third thing that you could do is you could, you just have to come up with any kind of solution that works for the two of you. So if you really wanted to sell the property, at that point you could. The other worst case scenario, and I think this is the real worst case scenario for anything related to real estate, is if all this bubble talk comes true. So if you sell the housing market correct by, let's say, 20%, there's no way they're going to qualify for the price they need at the end. That's a big what if, right? But in that case, what other real estate investments are going to be doing well? What stock investments are going to be doing well? If our real estate market takes a 20% tumble, I think the whole financial markets are going to be in a mess. So really, that's the absolute worst case scenario. But in that case, at least you own a piece of real estate. You could continue to own the piece of real estate. You can continue renting it out, and hopefully at some point down the road, the price is going to be higher than what you paid, and you'd still realize a profit.
So do you find that, Andrew, there's a big learning curve here? Like, how do you educate? Do you do seminars? Do you speak? How do you educate people? Because I'm sure, these guys are going to go to ownershipsolutions.ca, but we're not going to get everything there. So then from there, we give you a call, or how does it work?
Would that be on the client side or the investor side?
The investor side.
On the investor side, so what we do for the investor side is a couple different things. On our website, we've got some materials explaining how the rent-to-own program works, what the benefits are, what the drawbacks are. We have a video series that's up there that I put together a couple of years ago, and that does a good job of just going through and explaining the basics.
Okay, good.
Then there's 3 segments in that series which specifically walk through the numbers, and I find that really helps to get people wrapping their head around how it actually works in practice. In addition to that, we do seminars once in a while. We don't host our own seminars, but we speak at other events to try and educate investors on how this works. And really most of what we have is available on the website. So that's the best place for people to start if they want to learn how it works.
And so we're talking here in the promised land of Peel region, but as an investor, we know that we can invest really literally anywhere. Where do you predominantly kind of match the investor to the client, to the tenant up? Is it anywhere in Ontario you've done? You've done deals as far as where?
Well, last year we were looking at a couple of deals in Quebec. We didn't actually go ahead with those opportunities because they've got different laws out there. So the contracts that we work with are good here in Ontario, so we've kind of established that as
But anywhere in Ontario?
Our lending
Thunder Bay to down by the water?
I mean, Thunder Bay is a bit of a challenge. So most of our funding partners are based here in Toronto, and they prefer things that are closer to home. Not that they really have to go see, feel, touch very often, but it's nice to know that you could. So I find that we do a lot of properties within, let's say, a 2 to 3 hour drive of the GTA. So cities like Hamilton, Kitchener, Waterloo, Cambridge, Oshawa in the Durham region, Brampton, Scarborough, the more affordable areas. Barrie as well is very good for this. We've done a couple of deals in London. So really markets that are close to the GTA, but that have a substantial population. That's where it works very well.
And it's kind of the entry level, people who have never done this, if they want to get their feet wet and throw 50 grand at something, you're saying in those areas, that's where they can do it because the price points are around the 250 mark. Somebody who gets it and understands it and wants to be involved, you're doing properties that are worth $500,000, and you can kind of stay more in the core in the GTA if you were to do that.
Yeah, exactly. And I find that the rent-to-own is a really nice strategy for people when they're looking to get started, because it takes away a lot of those headaches you might have as a landlord. So if you're worried about, people calling you in the middle of the night to fix the toilet, that's something that a tenant buyer would take care of themselves, because they're responsible for their own maintenance, and they treat the property at that level of care.
That's in the contract.
That's in the contract, right? The other concern is, that people might run away and then you have to refill the property. There's no guarantee the rent-to-own client is going to stay there, but once they've given you that down payment, it's a lot more likely that you won't have to deal with that kind of situation. So I find that if you're a new investor, you're looking for some guidance for someone to help you put a deal together, rent-to-own is a really nice way to get started, because it eliminates a lot of those what-ifs and a lot of those potential headaches for you. Yeah,
especially if you're, we've talked before, I'm a portfolio investor. I'm more interested in increasing my capital, but most people that get into this game is they want passive income, they want cash flow, and there's really no better way, unless you've got a 20-plex or a student housing, which takes a lot of work, for an individual tenant, from one tenant for one dwelling. It's some great cash flow.
Yeah, and one of the nice things, and I've seen a lot of other investors do this, is that they'll start out with a rent-to-own, they get that great cash flow, and then they kind of see how they like the real estate investment business. So the nice thing with rent-to-own is that you've got that planned exit strategy. So let's say it's 3 years. Your tenant might not exercise at 3 years, but generally speaking, you know that you're in it for 3 years. So you can kind of plan around that. So I know that I've got a couple of rent-to-owns of my own coming due, so I'm already starting to think, how am I going to redeploy that capital? Right? And that's a real benefit, I find. It's also a drawback, because if you're trying to build a portfolio and the clients keep buying all your houses, it's a lot of work to keep putting together new deals.
But you've doubled your money in you know what I mean? If you're making 25-30% a year, you've doubled your money in that 3 years.
Yeah, and then you've got options, right? So now you can go out and you can either invest in more rent-to-own if you still think that's the best strategy for you at the time, or you could roll it over into, maybe you have 3 or 4 rent-to-owns coming due. You could take all that, all those sale proceeds and roll that into a multifamily building if you think that's the next step for you in your portfolio. So it really gives you options.
And so, maybe I'm a rent-to-own kind of guy in terms of the tenant. I'm the tenant, and I want to buy a property, but I'm also thinking ahead, and I want to buy an investment property as well. So maybe I could buy 2 units for 1 furnace. I'll live in one, somebody else live in the other one. Have you seen investors kind of agree to that? Of course, the investors will still have to make the same kind of money, but now when I'm done, I have kind of in-house investment property.
Yeah, I've seen it. Generally, what we're looking for with that is that it's a legal suite, because we don't want to be doing the illegal suite. The reason is we want to use that income as part of the client's income. So when they go to qualify for the mortgage, as long as it's a legal suite, they can include the basement income. So what we would do in that case is just set up one lease with the client, and then they would sublet that portion of the house, and then they'd start to get some experience being a landlord themselves. The caveat to that is, as the investor, you want to make sure they're screening their applicants properly and that you get a good subletter. You don't want to just let them move anyone in, because that can be problems.
So you're leaving it to them, and it's their prerogative, but I still have to be at the helm, because at the end of the day, right now, it's still my investment.
Yeah, and that's a more complicated scenario. Another common one is people ask if they can do improvements to the property. So generally speaking, we don't want to be buying fixer-uppers or handyman specials, but if you can buy something that's in move-in condition and is ready to live in now and you want to improve it, great. But we don't rely on that fact unless the client can show us they have the means, meaning the capital, to actually make those improvements happen. Because the last thing you want to do is, put someone in there with great intentions in a fixer-upper. They never fix it up. They never get the appraised price at the end, and now they're stuck, you're stuck, and you've got this crappy property on your hands. So unless you're in the reno game, I wouldn't suggest going the fixer-upper route.
So Andrew, what happens if I want to kind of purely treat this hands-off business? Is it possible that I never even have to meet the tenant? Not because I don't want to, but just sometimes business and pleasure don't mix. And so I'm the investor. They're already dealing with you, they're dealing with a mortgage specialist, they're dealing with a realtor. Do they have to even meet me?
They don't have to. So one of the options, but that's a separate option that we offer, is we'll do a joint venture agreement with our partner, with the funding partner, and we'll do all the property management. So we'll do the client follow-ups regardless of whether we're partnered on the deal. But if we're partnered on the deal, we also take care of collecting rent, dealing with any tenant issues which arise, which tend to be minimal in a rent-to-own scenario.
Yeah.
We do the annual inspections.
Oh, so you're willing to joint venture with me and do all the you do all the work, I put up the money,
Yeah.
and we're not making 35% a year, but we're making 17% a year.
Yeah.
That's fantastic.
Exactly. So what we do is, we cater towards different types of investors. One is the guy who wants the benefit of investing in real estate, but just doesn't have the time to put the deal together.
Yeah.
The other one is the person who...
Just hold that thought. We'll go to the break and we'll come right back. You're watching Real Investments. We're talking about Andrew, how to make some money in lease-to-owns. Don't go anywhere. We'll be back with his closing thoughts. Thanks for watching. Join Rav and friends at your Ultimate Income and Investment Property Show, April 5th and 6th at the International Center. Brian Baumer, Amanda Lang, Don Campbell, Scott McGilvery, and yes, yours truly. We'll be there. You don't want to miss it. Realestateinvestmentshow.com.